Thank you so much. It's an extreme pleasure to be here. They mentioned when I was asked to come and do this for Steve, I didn't have to think at all. Of course, I would do it for Steve. Steve was my advisor in graduate school and later on my colleague and co-author when I was at Yale. And it's hard to imagine what my academic career might have been without Steve. So he's been a profound influence on me in more ways than I can really enumerate. It's a little bit like asking, what would it be like if you hadn't learned to read? Because it's so much a part of me, everything that I've learned from him. One thing that's a very important characteristic of the way Steve thinks about things, and is a great strength of the area of finance, is there has to be a very close connection between theory, empirical work, and practice. And that's been the traditional strength of finance as an area. And Steve's research embodies that. Everything that he does, you can tell that somewhere in the back of his mind he's saying, can this be tested? If he's working on a theory, can it be tested? What impact would this have on practice? What's going on in practice that I might be able to understand better because of this? And he's not only thought about this and obviously motivated by this in his research, but he's also practiced it. That he has developed theories. He's been involved with the testing of theories, and he's also through his consulting and his other projects, other ventures, which he doesn't always tell me about because he thinks I might be able to reverse engineer some things. but it's clear that he's not only giving kind of a surface acknowledgement that these things are important, but he really lives it, and it shows up in the quality of the work and in the quality of his other endeavors. So when I was told I would have 20 minutes to talk about all of Steve's work, I laughed. It's a ridiculous task. He's done extremely important work in a whole bunch of different areas, and I can only touch on a few things in this time. Here's a partial list. In international economics, for example, he has a nice result with Walsh that there's an efficient portfolio that's efficient in every country, no matter what price index you care about. This is a result that probably Steve and I know about in this room, but it's a really nice result. If you have log utility, then the effect of the price level just separates out, and you want the same portfolio no matter what currency you care about. He'll talk later about recoverability. He's obviously done a lot of work in fixed income. Bob Merton will talk about that Cox-Ingersoll-Ross model, and also a variety of other papers that look at questions like what is the expectations hypothesis, and in what sense do we think that it can hold in different settings. I'm going to stay mostly away from my work with Steve. We have work on taxes, and we have work on APT and performance measurement for portfolios, and a bunch of other things. The list goes on and on. So I'm going to talk about just a few things because that's what I have time for, and it was really hard to pick the most important things, but I think these are things that are really important, and not everybody may know that he was involved with these things. So here's a list of some of Steve's path-breaking papers. Ross AER 73, I'll talk about some more. That was the first agency paper in finance or economics. He set up the standard way of talking about agency problems in terms of looking at it from the perspective of the principal with constraints for participation and incentive compatibility for the effort that you're planning. And that's been used in different forms for a long time, and is now just a standard way of doing this. Like a lot of other things that he's done, his approach to doing this has just become the standard approach, and it's not even cited anymore because it's just part of our standard toolkit. There's the arbitrage pricing theory, APT. This is related to the no arbitrage theorem, fundamental theorem of asset pricing, which I'll talk about later, but it's different. I think this is one of these cases where arbitrage is too useful a word to use only one way, and sometimes I think people could easily confuse the two sets of results, but there are two different areas here that are important. The arbitrage pricing theory gives a theoretical background, starting with the mutual fund separation theorem, and then following up with the pricing rule for why we should look at factors in asset prices when we're thinking about pricing. This is similar to Bob Merton's intertemporal asset pricing model, where the factors are the market portfolio and then additional factors that are state variables for future changes in the production possibility set. This is somewhat more general. I think both are interesting. If you look at the popular marketing materials that you see coming out of a lot of the investment firms right now, you'll see that they talk about risk factor-based investments, and this is basically a set of models that assumes a conditional APT for the pricing structure. I think that these models should also probably incorporate on the decision side some of Bob Merton's state variables, because that should be part of the value function. You shouldn't really be maximizing a single period model. But anyway, I think this is a really important contribution, and it's obviously affected the way that practitioners look at these things and organize their thinking. Risk-neutral pricing, the so-called martingale approach, was first done in the Cox and Ross JFE paper. I think a lot of people know the Harrison Krebs work that came later. I suspect that they learned about this result from the Cox and Ross paper, because Cox was at Stanford and they were doing reviews of his work for tenure and so forth. And I think, and they worked on making it more rigorous, but the economics is all there in Steve's paper. In Steve's work with John, they made a very simple argument. They said, if you look at prices in an economy, those prices that you see are actually consistent with many economies. And if we're going to look at an economy that's related to prices, why don't we look at the simplest possible economy? And the simplest possible economy is the economy in which agents have linear preferences, in which they're risk neutral. And in that economy, we can just price things using expected discounted values. So we get this result that's very generally true in a very large set of economies, but it's very simple. We can use these artificial probabilities, and they're different from the actual probabilities because we need to do an adjustment for risk preferences and undo that. And we use discounting to take cash flows that are in the future and discount them to the present. We do that to adjust for time preference. It's just a very simple idea. And it gives such a powerful tool, because if we're doing valuation exercise, we don't care about the actual probabilities. If we're doing portfolio optimization, we do, and we have to keep it for that. That's a different matter. But if we're doing evaluation, which is a large part of the business, then we just use the risk-neutral pricing. Spanning with options, there's a follow-on paper by Breed and Lissenberger that's similar to this. Steve's paper does it in a discrete state space, and he gets state prices as second differences. The Breeden and Litzenberger paper uses the same basic idea with a continuum of states, and they get a second derivative, but it's basically the same economic idea. This is the idea that you can look at option prices and invert them to figure out state prices. It's a very powerful idea, extremely useful. The Bell Journal paper, 77, the incentive signaling model. This along with Leland and Pyle, I'm not really sure which was written first. These were the first two signaling papers in finance. And it's really influential paper. This was actually the first paper of Steve's that I ever saw. When I was an undergraduate in Indiana, he came to Indiana University and presented this paper. And I, at that time, had been accepted for graduate school at two different places, at Rochester and the University of Pennsylvania. And I borrowed my friend's ideas so I could go to beer with the speaker afterwards. And I talked to him, and at that point, he said that if I came to Penn, that he would be happy to work with me. And this absolutely transformed my life. I mean, you can't have a better advisor. He's really generous with his students. He always says nice things about us when we don't deserve it. And it's really fortunate and lucky for me that this happened to me. The fundamental theorem of asset pricing. This is a result that I learned about from a paper of Steve's called A Simple Approach to the Evaluation of Risky Streams. I learned later that both this result and the APT originally were in a conference volume, Fred Bixler book, in a paper in there, which is an amazing paper, and it's buried in a book chapter that nobody can find anymore. But this result that he had is that there's no arbitrage if and only if there's a positive linear pricing rule. So when Steve would teach this, he would say, look, I know not everybody out there is optimizing. There are a lot of people, you run into them, you can tell they're not optimizing. Just talk to them for 10 minutes, ask them why they just bought some stocks, and they, you can tell there are a lot of people out there that aren't optimizing. But this result says, in some sense, it doesn't matter, in the sense that so long as there are some smart people out there, so there's no arbitrage, then you're going to get prices in the economy that look similar to the prices you would get in a competitive world. And that's a very powerful idea, and one that's very useful. So when I was teaching these results in my first job, I thought that was very important, so I came up with a name for it. And the first time I taught it, I called it the Fundamental Theorem of Finance. And because I thought it was very important. And then after a year or so, I thought, well, there are probably a lot of people who think there are a lot of important things in finance, and probably they get pissed off if they hear that I call this the Fundamental Theorem of Finance. So the second time I taught the class, I called the Fundamental Theorem of Asset Pricing. And in doing this, Steve had done all the heavy lifting in the earlier paper, but I added a third leg to remind students why we care about absence of arbitrage. So the Fundamental Theorem of Asset Pricing says there's no arbitrage if and only if there's a positive linear pricing rule that prices all assets, if and only if some agent with increasing preferences has an optimum. And this is a very handy result for a lot of things. For example, it used to be you go to seminars all the time and they say something like, well, you derive this in a no arbitrage framework, but is it consistent with equilibrium? Well, it turns out that it is, and this theorem shows that, because if there's no arbitrage, then there's some agent with increasing preferences who has an optimum, and you can construct an economy with just that agent and endow that agent with the optimal holding, and then you have an equilibrium. So basically, the implications at the level of asset prices of equilibrium and absence of arbitrage are the same. So that's a very useful result, and that's organizing result, which it's just part of me now, and it's something that when I think about finance, it's just automatic. And you can take this result and you can use it as a unifying framework to derive a lot of important things. On option pricing, Modigliani-Miller, put-call parity, a lot of different things just fall out of this very easily. Cox, Ross, and Rubenstein, the binomial option pricing model, that's a workhorse model in industry, and for people who know how to teach option pricing, that's the first thing they show. Usually when people talk about Black-Scholes in a first option pricing class, it's a wonderful model, but it's a black box because the mathematics is hard. But in the binomial model, it's very easy to see what's going on, and it's very easy to understand. This Coxier-Ross 81, this is a paper that looked at things like the expectations hypothesis and the local expectations hypothesis. And it makes the point that the expectations hypothesis in the term structure of interest rates is inconsistent with itself if you look at different maturities and there's any risk. And they substitute something which is actually widely used in practice as sort of the starting assumption in any term structure model where you're doing option pricing, which is a local expectations hypothesis, which says that locally, over short time interval, all assets have the same expected return. Coxier-Ross model, I think Bob's going to talk about that a lot later. That is one of the workhorse models in fixed income. In the paper, they have one-factor models and two-factor models. You don't know how many papers I was asked to review that said that they extended Coxier-Ross to a two-factor model. And for the academics here, I would recommend if you're going to extend a paper, you should read the whole thing. And not have the referee come back and say, well, actually, this was already done in section 4 of the original paper. But anyhow, that's just a wonderful paper, and it's extremely useful in practice. We already had the Vasicek model, which is a Gaussian model of interest rates with and without mean reversion, and that's easy to extend to a multi-factor model, and that's something that I've used in practice. But the nice thing about the Coxier-Ross model is that interest rates stay positive, so at least for nominal rates, that's a good assumption to have. And then this Gibbons-Ross-Shanken paper, this actually started with a paper by Steve himself with a little different assumptions, and that is one of the foundational papers in financial econometrics. It tells you how to do the test of the asset pricing model. Steve worked mostly on the theoretical side, but he wasn't bashful about working in the empirical work, or in this case, the econometric side as well. So let me run quickly through a few of these papers in a little more detail. By the way, as we heard it before, he does everything, and he does it with such enthusiasm. He does such a great job. I mean, there's so many people you say, oh, he's a great scholar, he's a terrible teacher. Not Steve. He's a great teacher. And everything he does in the classroom is very clear. He's really good with his students. He does consulting, he does things in practice. I don't know how he does all these things, but it's great. Okay, so the agency paper. So in the law and agency relationship is a situation where one agent hires somebody else to do something. It could be hires or assigns somebody else to do something. And in the law, if the agent does some damage to somebody, say there's a tort claim, then the principal may very well be Is this correct? Okay. And when do I finish, to make sure?
5 minutes.
Okay, good. Okay. Okay, so we have an agency problem here. He's assigned me to do this task, and I may have preferences to do something different than what he would really like me to do. And we're in a world of incomplete contracting, so we can't even implement Steve's solution here. So anyway, so the way Steve set up this agency problem, first of all, he's the one who taught us that this is basically has to do with a conflict of interest, what is called moral hazard in the insurance industry. In the insurance industry, moral hazard says that if I have an insurance, I may have an incentive not to take care, or in the extreme, I may have an incentive to intentionally damage. So if I have a factory and I have full insurance in the factory, then I won't have an incentive to maintain the fire sprinklers, and I may even have an incentive to set it on fire. This is moral hazard. And what Steve taught us is that in an agency relationship with a principal and agent, you have essentially the same problem. That the agent has, for example, to undertake effort to do the job. The agent may not like undertaking so much effort, and the principal would like the agent to work harder. So there's that conflict of interest, and how to model this. And the way that he set it up to model is really cunning, and this is before game theory talked about refinements and things, but the way he set it up sidesteps the issue of refinements. So one of the sort of technical problems that you could have is that there are fee schedules that the principal could give to the agent, incentive contracts, that for which there's no optimal response. But the way he set it up is that it's part of the constraint that the choice that the principal is planning for the agent to make is actually the optimal response to the contract. And because it's a constraint, you never run into this issue that says that, well, what happens if you say something there's no best response? I think it's also an interesting question what people do when there's no best response, but that's not what he did. But anyway, he set this up as a problem from the principal's perspective. The principal chooses a fee schedule for the agent, but that's subject to two constraints. One is the agent is paid enough that the agent actually wants to work for you at all and enter the contract. And the other is an incentive compatibility constraint, which says that the agent will actually choose to do what it is that you're planning. So anyway, this is the way that people model agency relationships now, and it's just a very standard approach, and it's led to a whole big literature. Okay, arbitrage pricing theory. There are actually lots more papers, including, I've even written a paper with Steve on this. Here are some of the important ones. Dick Roll is here. He wrote a couple of the empirical papers with Steve. So the mutual fund paper is an underlying theoretical paper. In the CAP-M, mutual fund separation is very important, and it says that no matter what your preference is, you want to hold a linear combination of two portfolios, an efficient portfolio on the frontier and the riskless asset. And this paper looks at what is the analog of that when you have many assets. So what assumptions do you need? And it turns out those assumptions are very close to the assumptions that end up being the APT. And this is a lot like the CAP-M, but it has multiple assets, multiple sources of price risks. I say this is used a lot in industry now. People talk about risk factor-based investments, and it's really a conditional version of this. Okay. The other one I'll talk about just very briefly is the fundamental theorem of asset pricing, and this is the one I've talked about before. what this says is the absence of arbitrage, existence of a positive linear pricing rule that prices all claims, and existence of a hypothetical agent who performs more or less and has an optimal portfolio. And this is extremely useful conceptually for thinking about things. And when we use this, we talk about how to represent the linear pricing rule. Then we get the Cox-Ross result that says you can do the risk-neutral pricing. So anyhow, that's all I have time for, and I am finishing more or less when you said. And so the agency problems maybe aren't so bad as they could be in some other context. We have no financial crisis here. And anyway, it's just an extreme pleasure and extreme honor for me to be invited here. And thanks so much to Deutsche Bank and all the hosts. And it's just I hope you have some sense, a little sense of the breadth and importance of Steve's work, and also just how influential he's been for me and for other people.